Today, we're plunging into a really fascinating freight market. It's almost contradictory, isn't it?
It really
You've
is.
got these soaring ocean rates on one side,
hmm
and then, bam, a domestic trucking sector that's really, really under pressure. It's like two completely different worlds at the same time.
That's exactly right. And for this deep dive, we've pulled together insights from, sources like FreightWaves, Transport Topics, KCH Transportation, Maersk, a good mix.
Right.
And our mission here is really to cut through all that noise. We want to give you the key takeaways, help you understand the forces shaping supply chains right now.
Welcome to Logistics Pulse, sponsored by Mothership. Skip the broker to save big on LTL shipments, or deliver same day nationwide.
We're talking geopolitics, potential regulatory stuff.
Exactly. And what it all means for you. We'll unpack it all.
Okay, so let's start with that big contrast you mentioned.
Yeah.
July 2025. Ocean freight versus trucking. On the ocean side, it's a surge, right?
Oh, absolutely. You've got geopolitical risk, think Suez Canal issues, but also, interestingly, maybe some cooling U.S.-China trade tensions. It's pushed spot rates, ocean spot rates, and bookings way up.
Sharply higher, yeah.
Yeah, and we're seeing really strong import demand, especially Europe to North America. Vessels are apparently full right through mid-July.
Wow.
Getting space into the U.S. is tough. Canada, maybe a bit more availability, but still tight.
And it's not just the Atlantic.
No, not at all. Services from the Indian subcontinent, the Middle East, they're hitting peak season. Capacity is very tight there too. It shows how quickly global risk can just shift everything. Makes planning incredibly tricky.
And Maersk had something specific on this, didn't they?
Yeah.
About the Pacific.
They did. They saw a big rebound in Trans-Pacific bookings back in June.
Yeah.
Big enough that they actually brought back vessel capacity they'd previously parked.
That's strong signal.
Huge signal. And FreightWaves is now saying, look, expect a sunnier Q3 for intermodal, the rail part of the journey, directly because of all these imports flooding in. It feels almost like boom times for the big shipping lines.
Right. Boom times there. But then you pivot to the domestic scene.
Right.
Trucking. And it's the opposite picture.
It's a stark contrast, yeah.
While the oceans are busy, truckload demand here is just flat, stagnant. No real rebound expected until maybe late in the year, closer to peak season.
And the core problem hasn't gone away?
Not at all. Truckers are still getting hammered by high costs, low rates. It's a real squeeze. And this fits with the bigger economic picture, right? Weaker consumer sentiment, even though the Fed left rates alone in June.
And manufacturing. That's a big piece of the puzzle for trucking demand. KCH Transportation had some grim numbers there.
Yeah, they pointed out U.S. manufacturing contracted in 25 of the last 26 months.
25 out of 26. That's rough.
It's incredibly rough. And get this for the squeeze. Input costs for manufacturers went from about 31% in December up to nearly 60% in May.
60%.
But the prices they could charge for their own goods, lagging way behind. So their margins just got crushed, and that pain flows directly downstream to trucking.
Okay, so let's dig into that trucking pain more. Costs, capacity, margins. ATRI's 2025 cost analysis had some surprising details, right? It did. You look at the headline number, and it seems, okay, average cost per mile dipped just slightly, 0.4% down to $2.26.
Which sounds good on the surface, but...
But it hides the real story, because non-fuel expenses, they climbed 3.6% to $1.78 per mile.
highest ever recorded.
Highest on record. And what's driving that? It's the big stuff. Driver wages, truck and trailer payments, benefits. These aren't things you can just cut easily.
Right. These are core operating costs. They're sticky.
Exactly. So it's not just about fuel prices fluctuating anymore. This is about the fundamental economics of running a truck. It's getting harder and harder to make it work.
So costs are structurally higher, essentially. And that's affecting capacity, but in a weird way. Capacity is down 2.2%.
Which you'd think might help rates in a normal market.
Right. But then empty miles are up to 16.7%. How does that work?
It's inefficient. It suggests that even though there are technically fewer trucks, the ones running aren't finding enough loads consistently. Why? Sources say it's aging trucks being retired, plus fewer drivers wanting to stick around or join the industry.
Because the economics are so tough.
Exactly. Operating margins for many truckload carriers are negative. They're losing money. And the freight being offered, the tender volumes are just weak. Below 2023 levels, barely above 2018. It's a really tough environment.
And layered on top of all these internal market issues, you've got this big cloud of uncertainty from geopolitics and tariffs. That makes planning almost impossible, right?
Totally. You've got these start-stop tariffs, this weak freight market, shippers, carriers, nobody knows which way things are headed. Transport topics specifically mention President Trump's tariff extensions, new trade talks. It just makes the trajectory completely unclear.
Murky at best.
Yeah, and the result of everyone's just holding back, holding their breath, as one source put it. Nobody wants to make big long-term investments right now, which of course just slows everything down further.
And this uncertainty, it hits the ports hard, doesn't it? Where the global meets the domestic.
Absolutely. There's a real warning that uneven port volumes, delays because of tariff issues, it could actually tip the freight market back towards recession.
We're seeing real-world impacts already.
We are. Maersk pointed out that drayage capacity, that's the local trucking moving containers from the ports, is getting tight on the West Coast. Why? Because of import surges tied to these tariffs.
Ah, so everyone rushes to import before a tariff hits?
Exactly. And it causes log jams. Equipment gets stuck in the wrong place, dwell times get longer. It ripples through the system.
Interesting how shippers are coping, though. Warehousing demand is still strong.
Yeah, because they're playing defense. They're using flexible storage, holding more inventory than maybe they otherwise would, just as a hedge, a buffer against tariff changes or other disruptions.
Even though manufacturing is contracting and firms are freezing, hiring, or laying off, inventories are still seen as too low by some retailers and distributors.
It's a paradox, isn't it? It really shows how much uncertainty is driving decisions. But, okay, amid all this gloom for trucking, there might be maybe a flicker of hope. On the regulatory side.
Ah, right. The EPA news. Tell us about that.
So, end of July, EPA Administrator Lee Zeldin announced a proposal, a big one, to overturn the 2009 endangerment finding.
Okay, remind us what that finding does.
It's the legal basis, essentially. It's the EPA's determination that greenhouse gases endanger public health. Without that finding, the EPA basically loses its authority to set federal greenhouse gas standards for new vehicles, including trucks.
So, if this proposal goes through...
If it's finalized, yeah. It would wipe out all the federal GHG standards going back to 2010. A massive change.
And the trucking industry's reaction was...
Positive. They praised it, yes. According to the sources, their argument is that the previous emissions rules were just unrealistic, too expensive, economically damaging for them.
Okay. And just to be clear, we're reporting their stance here, not taking a side. It's just part of the current landscape they're navigating.
Exactly. It's a factor in their potential cost structure going forward.
So we've got this incredibly mixed bag. Ocean booming, trucking struggling, costs are weird, tariffs are uncertain, regulations might change. What does this all mean looking ahead to Q3? KCH Transportation laid out a few possibilities, right?
Yeah, they basically said there are 3 ways Q3 could play out, highlighting just how uncertain things are.
Okay, what's scenario 1?
Scenario 1, an inventory-driven rebound. The idea is that inventories are actually quite low despite the warehousing, and businesses will have to restock, which could kickstart demand.
Plausible. Scenario 2.
Less optimistic. A margin collapse. This happens if those squeezed manufacturers finally do raise prices significantly to cover their input costs.
Which then crushes consumer demand because things get too expensive.
Exactly, leading to a drop in spending and activity.
Okay, and the third option?
The third one feels, well, maybe the most likely to some right now, the muddle-through scenario. Basically, things just stay flat. PMI readings at manufacturing index don't really go up or down significantly, just stagnation.
Muddle through doesn't sound inspiring, but maybe realistic. So when you hear those 3 very different paths, rebound, collapse, or muddle, what should you be thinking about? Whether you're running a business or just, buying things.
Yeah. How does this actually hit home? What does it mean for prices you pay, for whether the stuff you want is on the shelf, maybe even for jobs in certain industries? Those are the real questions, aren't they?
Definitely. It's been quite a deep dive unpacking this. We've seen this stark split, ocean versus truckload.
Dug into the cost pressures, the geopolitical fog, the potential regulatory shifts.
It's incredibly complex. So maybe the final thought to leave folks with is this. In a world pulling the freight market in so many different directions at once, how much more adaptable do supply chains need to be just to survive, to muddle through, let alone actually thrive?
Right, and what kind of maybe unexpected innovations might actually come out of all this pressure cooker uncertainty? That's something to really think about.
For more insights like these, don't forget to subscribe to Logistics Pulse on YouTube, Spotify, or wherever you get your podcasts.